Hello, everybody. Good morning and welcome to Deloitte today. We want to thank you all for taking the time to join us. For those of you in person and online, we want to say thank you very much for joining us for the next 2.5 hours. We are looking to discuss raising capital for businesses. So UKGCC and Deloitte have partnered together today to talk about demystifying investor expectations and what you need to know before seeking capital. We realize that a lot of businesses today are looking to raise capital and they don't know where to begin. So the UKGCC has championed the efforts to improve investor climate in Ghana, as well as globally. And today we've partnered with Deloitte to bring you this webinar series. So I want to thank you all for joining us today. For those of you in the room, we ask that you take a moment to make sure that your phones are on silent. Okay, and if you need to use the bathroom, it's on the outside to the left. For those of you online, we hope that you can hear us. There's a question and answer box where you can put your comments in, and once we reach that section, we will take your comments and then we'll try and answer them. So today we're hoping that by the end of the session, the 4 key things that we're looking to achieve is that you will be able to understand the common myths around raising capital, what the red flags for investors are, and what to look for beyond the numbers, and finally, how to position your business for investment. So I would like to thank you all once again, and welcome to today's session. I will hand over to Ajoba Chiama for the opening remarks.
Thank you very much. Good morning to those of you here in person and to everyone online who has joined us this morning. On behalf of the UK Ghana Chamber of Commerce, I would like to welcome you to the first in a 4-part series, which we have themed Investment Readiness 101. It's a practical guide for business, and we at the UK Ghana Chamber of Commerce, our objective is to support businesses at every stage of their growth journey. Whether you are starting out, scaling up, or seeking international expansion. And this is the reason for today's hybrid webinar/seminar. I would like to thank Deloitte Ghana, a valued member of our chamber, for partnering us to deliver this hybrid session and for generously hosting us in their beautiful conference facility. We're grateful for your continued support and shared commitment to enterprise development. To those of you online or in person whose companies are not in our membership, I would like to use this opportunity also to invite you to consider joining our membership. Our work is anchored in a 3-pronged approach that offers real value for our members. And we host very high impact events, trade missions, and business matchmaking services to connect our members as well as with key players across industries in Ghana and the UK. We champion your business concerns with policymakers and regulators to help shape a more enabling environment for private sector growth. And we also offer practical support such as market intelligence, regulatory guidance, and access to promotional platforms that enable our members to seize new opportunities. If you're looking for a strategic partner to support your business ambitions, we would be delighted to welcome you into the UK Ghana Chamber of Commerce network. I encourage everyone participating in today's session to take full advantage of it, ask questions, engage our speakers, and connect with each other. The knowledge and relationships you build today could make all the difference on your investment journey. Thank you once again to Deloitte Ghana, to our speakers, and to each of you for being here. I wish you all a productive and insightful session. Thank you.
Thank you very much, Ajoba. Please let's give her another round of applause. The Executive Director of the UKGCC. Thank you very much. So we'd like to invite Mr. Yaolate, who's a partner with Deloitte Ghana, to give us the keynote.
Thank you very much, Samira. Good morning, everyone. So, distinguished invited guests, panelists, speakers, fellow Deloittians, UK GCC team, and Esteemed listeners and viewers and participants, it's a pleasure to host you as Deloitte for another session of SME webinar series. We've collaborated with institutions like UKGCC, among other institutions, to organize seminars like this for SMEs, and this is one of them that we are looking at. Today, we'll talk about what you need to know before seeking capital. When you ask SMEs, what is your biggest problem? More than 90% are likely to say they need capital. They don't have money. But what they don't know is that there are things you need to do, or there are some things you need to know before you get a capital. So for most of them, it's not money they need. They need to put their books in order to get the money. So a few years ago, we did a research on SMEs, and there were about 4 key findings that came up. So the first one for SMEs, that's the 4 key issues or challenges that SMEs have in Ghana. Like I said, they said need for capital. And under the need for capital, we try to understand why they are not able to access capital. And the first reason is a lot of them do not keep good books of accounts. So if you sit down with the CEO, he will be able to tell you how much sales he makes a week, how much or how many employees he's got, and what his costs are, etc. But if you ask him, where is this written? They are all in his head. So if you don't keep proper books of accounts, you will not be able to access the capital. The second issue that we came up with was corporate governance. So we've made a lot of SME business an institution for blood relations. So it's somebody and his children, uncles, aunties, etc. Corporate governance is a serious matter that you have to take seriously. And so if you don't have proper corporate governance, you probably may not have the capital that you need. And then the third one is cumbersome regulatory procedures, which is more like exogenous to the SMEs. 92% of companies registered in Ghana at the time we did this research are SMEs. But guess how much they contribute in terms of tax revenue? They only contribute 4% of tax revenue. So 92% of companies registered in Ghana are SMEs, but they only contribute 4% of tax revenue. So 8% of companies registered in Ghana contribute about 96% of tax revenue from companies. So that means that the SMEs we have, we need to grow them in order to generate the revenue that we need. If you don't grow the SMEs, you will not be able to get the revenue that we need. And also related to the cumbersome regulatory challenges are the fact that the tax authorities are always on them. The tax laws are being amended every now and then, and so they are forced to get around these tax laws and all. But if we make the laws or tax laws clear, easy, and avoid frequent amendments, they will be able to comply with these tax regulations. Then the last one is lack of unique products. A lot of SMEs in Ghana do the copy and paste. So you see them all around when you are driving in town. So if somebody starts selling bread, hot bread, and you see so many people buying, the next 2 or 3 shops will start selling bread or hot bread, then just following through. So a lot of SMEs do the copy and paste, then they are not able to differentiate themselves. And if you follow what's happening with Tesla and others, if you don't differentiate your product, nobody will patronize it. So the lack of unique product was the last one. So corporate governance, lack of unique products, not keeping proper books of accounts are things you need to do or things you need to know before you start looking for capital. If you don't do these things, it will be a challenge for you to do the capital. So knowing all this, Deloitte is happy to collaborate with UKGCC to organize this event. We have the opportunity to listen to people who have provided capital, people who have supported business to access capital, and today it's an opportunity for you to listen. So those of you online, take advantage, prepare to take notes, and then ask all the questions that you have. Here, there is no irrelevant question. We are not in the courtroom, so every question is relevant. So ask whatever question you want to ask, and we'll be glad to answer them. If you do not, or your question is not even answered, please send them through to us. You collate them and have the speakers respond to them in due course. So we'll do all of that after this event. So please feel relaxed here. Those of you here with us in person, we provided some snacks so you can enjoy. Those online, please grab a bottle of water and then enjoy yourself. Thank you very much.
Thank you, Yao. So we will delve right into our first presentation by Barry Yuri.
Hello, can you hear me? I think I don't use it. Morning, everybody. How are we doing today? All right. Like Samara said, my name is Barry Yuri. I'm a senior manager with the evaluation and modeling team within financial advisory services. Happy to be here. Have a short presentation for you regarding demystifying investor expectations and what entrepreneurs need to know before they access capital. Hopefully, this will be a fun, interactive presentation. Like Samara said, we'll take your questions during the Q&A session. And yeah, I think without any further ado, let's jump into it. If you see me moving around, it's probably because of the AC, so I'm trying to keep warm. So that and enthusiasm. So let's get into it. So firstly, the outline of the presentation is going to be firstly, brief intro into Deloitte and what we do, followed by the Deloitte SME advisory, small and medium enterprises. And then thirdly, which is the crux of the presentation, what investors look for when making investments. And fourth, last, what are the key investment considerations that entrepreneurs need to keep in mind when raising capital? All right, so first up is the Deloitte profile. So Deloitte is one of the big four accounting professional services firms in Ghana. We have a presence in 34 African countries, and within Deloitte, there are 5 main service offerings. So there's audit and assurance, there's financial advisory, of which I'm part of the team, there's risk advisory, there's tax and regulatory, and then lastly, there's consulting. Next slide. Part of our experience comes from covering various industries. So within Deloitte, there are 6 main industries that we look to cover. One is consumer. Second is energy resources and industrials. Third is financial services. Fourth is life sciences and healthcare. Fifth is government and public services. And last but not least is TMT, or technology, media, and telecom. So these are the various industries that we cover and have expertise in, that we look to serve our corporate clients and SMEs such as yourselves. Within financial advisory services, on the next slide, there's a variety of services that we offer to our clients, which were also very amenable to SMEs. First is the corporate finance advisory. So some of the services we provide under corporate finance are capital raising, so debt and equity, merger and acquisition advisory, flotation services. Under restructuring, some of the services we provide are financial restructuring, independent business review, turnaround and performance improvement, and crisis management. We also provide valuation and modeling services, which team I lead. There's business valuation, there's financial modeling, there's impairment testing, there's intangible assets valuation. Fifth, we have transaction services, which is buy-side and sell-side due diligence. So as SMEs entrepreneurs, when you look to do transactions, we usually have a transaction team that will help support either the entrepreneurs looking to raise capital or the investors looking to make investments. There's also transaction readiness, transaction due diligence and execution, and reporting accountant. And then lastly, we have the infrastructure and capital project team, which handles feasibility studies and business planning, and infrastructure and capital projects. Next slide. Briefly just talk about the SME advisory services that Deloitte have. The SME advisory services are provided by what we call Deloitte Private, which provides a range of services towards SMEs, family-owned businesses, large private companies, and high net worth individuals. So as you can see on the slide, there's the 4 pillars of the clients that we serve under Deloitte Private, which is family businesses, family offices, and high net worth individuals. Secondly, we cater to privately owned businesses, such as SMEs and micro SMEs. Thirdly, we cater to private equity funds and companies under Deloitte Private. And lastly, we cater to emerging growth companies, which are venture-backed capital, startups, and small companies that have strong growth potential. Next slide, is just going to show some of the services that we provide to SMEs. One is preparation of business plans. Second is business incubation services. Third is investor readiness, which is part of what we're talking about today and why we're here. Fourth is capital raise, which is a matter that's dear to the hearts of a lot of SMEs and entrepreneurs. Fifth is access to market. Sixth is access to finance. Then we have financial modeling. And lastly, we have capacity building, where we help support SMEs build up their capacity to serve customers and to grow the business. Next slide is just showing some of the stakeholder engagements we've had as Deloitte. So I'm sure you've heard of some of them. There's the Ghana CEO Summit that we host. There's the Ghana SME and Young CEO Summit. There's the Deloitte Economic Dialogue that we just had recently. There's also an SME Business Direction series that we have in collaboration with Access Bank, where we help support SMEs build their capacity as they look to grow their business. And then you can also see there's a future of grants management that we do. Now, going to the next section, which is why we're all here. Drumroll, what investors look for when making investments, which is why we're all here. So firstly, when you're looking to engage with investors, some of the strategic imperatives that you need to look at, next slide, please. Some of the strategic imperatives you need to consider is, one, where you are in terms of your history and your growth trend. Two, where do you want to get to? Are your ambitions or projections feasible, realistic, and achievable? Three, describing how funding will help you increase your output, which is how is funding going to help you scale your business? And then fourth is, when you are applying for funding, how do you intend to use the funds? Because before you raise capital from investors, they'll want to know how you're going to put their money to use. And you have to be able to explain what the sources of funds are going to be and what they're going to be put towards. And all this comes together to help you assess the gap that you have in your funding. And you also have to explain the funding required and the limitations that you have. Next slide. As part of the strategic imperative, when you're raising capital from investors, there's two areas that you usually look into. One is financial, the second is operational. So when you talk about financial imperative, investors want to know what has been the revenue growth of the business to date. You'll hear about what are the margins of the business, which is what's the gross profit margin, what's the EBITDA margin, which is earnings before interest and tax and depreciation and amortization, what's your net profit margin. You'll hear about returns in terms of what is the net profit of the business. If it pays any dividends, what are those dividends? What are the leverage ratios? So leverage refers to how much debt a business is carrying, because investors will always want to know how indebted the business is before they make an investment, because it helps them determine whether the business can pay back the investment. Then, importantly, you also hear about cash flow projections, which is the investors want to know what are your projections for your cash flow the next 5-10 years. How do you see the business doing? Because ultimately, investors will focus on the cash the business generates. And it's important to them when they make the decisions about who to invest in. And then also, lastly, this focus on budget performance. The reason why this is important is investors want to get a sense of how good are you at meeting your budget historically. Do you budget to make 100 CDs and then only make 50? How accurate is the business at forecasting? So this is important to investors. So usually this will come up under the financials. Now, when it comes to operational metrics, some of the metrics you hear about are retention rates, which is how good is the business at retaining customers. You'll hear about customer attrition is how many clients or customers does the business lose during a particular period. You also hear about the customer lifetime value, which is what is the value of a customer over the life of their relationship with the business. You'll hear about customer acquisition costs. How much does it cost a business to acquire new customers? And this will take into account marketing and selling costs. Fifth, you hear about conversion rates, which sometimes some businesses will have websites or do marketing to attract new customers and clients. And when they do this, investors want to know what is the conversion rate of when you, let's say, have a website and you want to get people to sign up to your business or your services. How many new customers do you convert? And then lastly, there's what's called the viral coefficient. So this is essentially just a measure of the efficacy of the referrals from current customers, in terms of how many new customers do you get based off referrals from existing customers. Next slide, please. Now, another area where it's of importance when you're interacting with investors is financial forecasts. And usually the discussion around financial forecasts focuses on these particular areas. You will usually have to develop a 5 to 10 year forecast of where you see the business now versus where it's going to be in so in terms of revenue, costs, and profits. Now, assumptions you use to drive your financial forecasts, they need to be credible and market tested because investors will query any assumptions you have, and if they don't appear to be credible, it makes raising capital from such investors more difficult. So it's always critical that your assumptions are market tested. Thirdly, and this is very important for a lot of SMEs and entrepreneurs, there's a need to develop forecasts for your best case and worst case scenarios. Because projections are assumptions we make about the future which may occur, may not occur. So if they don't, what's the worst case scenario for the entrepreneurs? And in the worst case scenario, are you still a viable business? Are you still viable enough to invest in? So it's important that SMEs develop these best case and worst case scenarios. Fifth is you will need to highlight certain key investment metrics that a lot of investors will want to know before deciding to make an investment. So frequently you hear about a return on equity, you'll hear about return on assets, and you hear about leverage. Leverage, which is how much debt is a business carrying. And with your financial projections, because numbers may drown out or bore your target audience, you usually want to include some charts and visualizing trends which are relevant so that it captures your investors' attention more. So these are some key aspects you need to look at in terms of financial forecast. Now, one key aspect, especially for our environment, is risk assessment. Investors know that investing in SMEs is high risk, and because it's high risk, it's also high reward. But in looking at high risk investments, there's certain elements that investors want to know that SMEs, entrepreneurs such as yourselves, will have certain risks in mind and have strategies for mitigating them. So a few of the key risks that investors will usually look out for is forex risk, which is very pertinent in our environment given how the CD usually depreciates against the US dollar. So you need to be able to impress upon investors how you to manage CD depreciation in case, for example, a lot of your costs in US dollars. How are you going to manage that as a business when they make the investment in you? Second is reputational risk. The environment we're in, unfortunately, you will find bad characters who are in the space. So you want to avoid as much as possible being in business with them because it affects the business reputation. So how do you mitigate such risks if you do end up working with such characters? Third is data security and privacy. So in this digital information age that we're in, data security is very key for a lot of investors. How you protect customer data. There's laws about this. So you also, if you're a business that has a lot of customer data information, you need to have strategies for how you protect that data. If that data is breached, how are you going to remedy the situation? Fourth is market failure. Now, market failure can be the sense of you may want to have a product or service. Let's say you want to export it to the US. Now, given what's going on in the US and the tariff wars, you may wake up one day and find out that your goods now cost 10, 20, 30% more. How do you handle that as a business? Does it make your business viable anymore? So you have to have mitigation strategies for this. And then fifth is equipment failure. So any property or equipment that the business has, how do you handle power outages or interruptions? Do you have backup power supplies? So these are some of the things that investors want to look out for from entrepreneurs. And when you're interacting with them, you need to have this at the back of your mind and have such strategies down, because more often than not, the investors will ask you about these mitigation strategies. Now, next, talk about the key investment considerations. Next slide is, and the reason we're here is, there's a lot of myths when it comes to raising capital. And we're just trying to show you the reality from the myth with some of these that we selected. There's 6 of them, but there's infinitely more in our environment, but we thought these are 6 of the best that you should know. One is, once you secured funding, your business has succeeded. That is furthest from the truth. Securing funding is good for all businesses, but it's a means to an end, which is scaling up the business. So you need to have that mindset that it's part of the journey, it's not the destination. And what happens is a lot of entrepreneurs focus on the capital raise at the expense of developing or sustaining the fundamentals of the business. So you keep focusing on raising capital, but you're not focusing on how do you scale the business, how do you make it more profitable. And eventually, the business ends up failing because you've been so focused on capital raise versus making the business stronger, more sustainable. Second myth is a groundbreaking idea will naturally attract funding and a high valuation. So situations where usually innovative ideas will tend to generate high valuations, but investors are also concerned about the sustainability and the profitability of the business and how the management team can execute. So it's not just about, I have a fantastic idea, it's automatically going to be worth millions. No. Investors also look at how you're going to execute. If you can articulate to them how you execute the growth of the business, you've lost them. Thirdly is that when you're raising capital, you have to convince every single investor that your business or SME is a worthwhile investment, which could be the furthest from the truth, because there are certain investors who have specific industries they're going to invest in. So you need to know what the investment criteria is or requirements and focus on the ones that invest in your space. Don't waste energy looking at investors who don't invest in agribusiness if you're an agribusiness company. It's something that's key because a lot of people think investors will invest in all industries, and that's the farthest thing from the truth. Fourth is venture capitalists are solely motivated by potential for high financial returns, and they don't consider any other factors. Now, usually, while financial returns are a key criteria for venture capitalists, they also look at how the business is going to grow, how it's going to support key industries, and they're also interested in establishing long-term relationships because venture capitalists will tend to be in a business for 5 to 7, 8 years. So they're interested in how the business does and how it grows. So their focus is not just going to be on how much money can I make. There's also an interest in your business succeeding. Fifth is angel investors only invest in technology companies. So angel investors tend to be very high net worth or wealthy individuals who invest in multiple companies. Now, there tends to be a lot of attention on technology startups, but angel investors also focus on other industries such as agribusiness or healthcare. So it's not just tech that angel investors look in. And then lastly, for businesses that are looking to get loans, you don't need to have a perfect credit to get loans. Now, lenders or lending institutions, they tend to look at a variety of factors when giving loans to a business, which such as the revenue of the business, the cash flow, what's your growth potential. So there's other factors that go into lenders' decisions to give you financing. So don't feel as SMEs that you need to have perfect credit to get loans. That's not the case. Next slide. So as an SME, you need to have a good understanding of investors' needs before you go and approach them. And there's 3 key factors you need to think of. One is, what is the investor's investment objective? When you talk about investment objective, investors will usually have a timeline for how long they want to invest in the business, the kind of impact they want the investment to make, and when they exit, a lot of investors will have an exit value or multiple in mind. So sometimes you need to do this research into what is this investment objective for these investors before you interact with them. Second is, make sure you know the focus area of your investors. If an investor is only focused on fintech, as an agribusiness or healthcare, don't waste time approaching these investors because they usually turn you away and it's wasted energy. Thirdly, know what investors are passionate about. If investors are passionate about social impact and you have a business that makes a social impact, focus on that passion and interact with them on a human level. It usually helps with capital raise. Even though investors are guided largely by logic and returns, for those that are more passionate and into making social impact with their investments, focusing on this passion can help you win funding from such investors. Next slide. So some of the key considerations that you have to look at as investments, there's 6 of them. So first one is, and these are some of the areas that investors will focus on, having experienced management. So investors are looking out for SMEs that have experienced management teams, because usually this is a good sign that management can execute on the vision and the aim of the business. Second is diversity in products and services. So investors want to invest in a business that has a diverse customer base, as opposed to a business that has 1 or 2 main clients, because that represents a risk to the investment. If the 1 or 2 clients end up leaving your business, is it viable anymore? So usually SMEs that can show a diversity in client or customer base tend to stand a better chance with investors. The sustainable development goals. So there's 17 sustainable development goals by the UN, which touched upon sustainability and development. So for entrepreneurs, SMEs that work in industries or sectors that touch on these goals, it's a signal to some investors that you're aligned with the SDGs from the UN. And you always have investors that are looking to make investments in companies that are promoting SDG goals. Fourth is the social impact, where you have investors that these days more and more are looking to make investments in companies that are profitable, but also have a positive social impact. So if you have an SME that is selling goods to the community and helping empowering women, for example, there's a lot of investors who are looking to invest in such businesses. So you have to keep an eye out for companies that are looking to make investments with a social impact. You also have the use of funds, which is whenever you approach an investor for funds, you have to be able to, in great detail, explain what you plan to use the funds for. You can't approach an investor and say, I want $100,000 and $50,000 is for rainy day fund. That you will be dead on arrival. So you need to be able to explain in great detail what you're going to use their money for, because investors have to explain to their backers what they've invested in and what it's supposed to be used for. Fifth, you'll usually hear about return on investment, which is when investors make an investment, whether it's debt or equity, they expect to make a return or profit on their investment. Usually, if you hear about repayment of capital, when you hear about return on investment, that's usually in relation to debt financing, where you take out a loan and you have to pay back the principal of the loan plus interest. And then lastly, and also importantly, you have to have robust and good financials, like Yao alluded to earlier. A lot of investors, when they invest in SMEs, if you don't keep good financial records, it can deter them from making investments. So if you're running a business and everything is in your head as an entrepreneur, you need to start developing systems where you document your financials or your sales or your costs, even look into getting accountants to do your bookkeeping for you, because any investor who's worth his or her salt, will do exhaustive due diligence on your records. And if you don't have those records, for some investors, they can't invest in companies if they don't have the financial records. And then as an entrepreneur, you also have to pay attention to what's called EBITDA, which is your earnings before interest, taxes, depreciation, amortization. It's a key financial metric that a lot of investors pay attention to. So when you start your business, your EBITDA may be negative because your costs are more than your revenue. But as the business grows and scales, your EBITDA is expected to turn positive. So businesses will usually look to invest in companies that have positive EBITDAs. So it's something to keep an eye on as an entrepreneur or owner of an SME. Next slide. Now, reason we're here is to talk about demystifying the investment process, but we also need to be aware of certain deal breakers that occur when SMEs are looking to raise financing from investors. One is lack of knowledge of competitors. There's times you will see SMEs and companies going to raise funding and thinking that they have a unique product and pitching it as such, only to be told by the investor, do you know company A, B, C, D are also doing what you're doing? And if you're unaware of that, it's not a good sign to investors, because it shows that you haven't done enough market research on your competitors. Because investors want to invest in a product or service that has a unique selling point, a USP. So if you have competitors, then you need to explain what is your USP such that you're differentiated from the competition. So that's one, not knowing who your competitors are. Two is your business cash flows. If your cash position tends to be low over the long run, or your cash flows tend to decrease and your cash flows aren't increasing, investors tend to be hesitant about investing in such a business because ultimately investors are concerned about cash flows in the business, and any business that's performing well will tend to generate positive cash flows. So if you run a business for 2-3 years and you're losing cash all the time, it's a red sign to them. And then also you hear about what they call burn rate, which is how much cash SMEs, entrepreneurs go through when they're looking to scale the business. If you have a continuously high burn rate, for a lot of investors, it's a red flag because it means that the money they put in is going to get used quickly and it's not going to grow the productive capacity of the business. So that's a red flag for them. Thirdly is SMEs, entrepreneurs who outsource core competencies. So what do you mean by core competencies? If you're a business owner, some of the core functions are going to be your sales, your marketing, and etc. So, and let's say if you're a tech company, your developers. Now, if you hire a developer who has another daytime job, that's a risk to an investor because if that developer wakes up tomorrow and decides, I don't want to work in your business anymore, your business is in trouble. So usually investors, if they see a business where some key competencies are outsourced or outside the company, it's a red flag to them because they want staff who are fully committed to the SME or the business. So usually if you're outsourcing certain key competencies, at some point you want to bring them in to the business. Fourthly is what we call concentration risk. If you as a business have one or two main customers, what happens if those one or two customers end up leaving you? Your business suffers and you may have to shut down. So this is why it's important to have a diversity of customers. You may have a concentration when you start up the business, but over time, investors want to see diversification of your products or your services or your clients. So it's something you need to keep an eye on. If you have one or two main clients, you want to look or present a plan for diversifying your customer base. And then last but not least, there's financial statements. With a lot of SMEs, when it comes to capital raising, this is a big area of concern because a lot of SMEs do not have good financial records. And when you go into the due diligence with investors, there's no information for them to go through. And investors will tend to be very risk averse. So it's key that when you're looking to engage investors for capital, please make sure that your financials are as ready as can be when you interact with them. And lastly, obviously, if you're a business and you have flawed financials, any investor knows that is not going to touch your business. So as much as you can, make sure your financials stand up to scrutiny with investors. I want to end on this note with when you're looking to raise financing, have the mindset of more than funding, which means don't just approach investors purely looking to get money. Approach them with the mindset of look at investors as potential mentors to your business. In that regard, you can also look to raise or seek advice from them as much as it's professionally allowed. Don't go and nag them and essentially ask them to be your staff and throw a million ideas at them because they're busy individuals. Thirdly, you can always go to investors as an SME looking for more than funding. If you need guidance or thoughts on how to get to the next level, investors are not averse to providing this advice. You stand out more compared to a competitor who's just purely after them for money because they get those requests all day. And then lastly, you can always discuss your challenges and your obstacles and ask for non-financial assistance from investors. There's a lot of them who are willing to help SMEs get to the next stage, and all you have to do is ask. But you also have to be genuine in seeking this help. And this all just ties into approaching investors with a beyond the cash mindset, which is don't just go to them looking for purely cash and nothing else. Usually it doesn't help you stand out, but if you look for advice and for non-financial assistance, sometimes you end up getting a better shot of getting financing from said investors. So with that brings me to the end of my presentation. Thank you very much. I hope you've enjoyed it.
All right. Thank you very much, Barry. So we're going to segue right into the panel discussion. So after Barry has given us some of the myths and deal breakers, we're hoping that he can give us a bit more. So I'd like to invite Barry to join the panel. Barry is a senior manager with financial advisory in Deloitte, Ghana. He has over 8 years experience with Big Four accounting firms. He has experience in providing advisory services, business valuations, financial modeling, business planning, information memorandum preparation, feasibility, financial accountant, has an MSc in finance and a BSc in international business administration. Thank you, Barry. Okay, so I would like to invite our next panelist, David Tete. David is an investment banker with many years of experience in the African capital markets. CEO of Investment Holdings and Advisory Limited. He works with private markets, has covered setup and structuring of private debt funds, and structuring and delivery of technical assistance programs. He is in public markets. He has led several equity and debt capital raising transactions across financial services, infrastructure, energy, FMCG. David's market building network includes developing markets for ETFs, green and sustainable bonds, commercial papers, and fixed income. He is also a consultant for the Ghana Stock Exchange, Financial Sector Deepening Africa, and the BII. Thank you, David. Okay, and our final panelist is Mr. Shakib Nazir. Shakib is a technology entrepreneur who works to develop and invest in businesses that use technology to solve everyday problems in emerging markets. Shakib is a director and shareholder of CrossSwitch International of Luxembourg and is also the CEO of Mojo Payments Limited, which was licensed in 2023 by the Bank of Ghana as an enhanced payment system provider. Shakib is a major shareholder and CEO of People's Pension Holding, which is the holding company of People's Pension Trust Ghana, licensed by the National Pensions Regulatory Authority of Ghana as a corporate trustee to provide corporate and private pensions. Shakib is also an angel investor with focus on impact technology in Africa. Shakib holds a BSc in computer science and physics from the University of Ghana and an MSc in information systems engineering from the University of Manchester. So thank you very much, gentlemen, for joining me today.
Thank you for having us.
Barry, I'm going to start with you, since you spoke about some of the myths around investing. So can you please enlighten us a little more on some of the myths?
Okay, so I think one of the biggest myths with capital raising is that when you successfully raise capital from investors, you've won and that's it. And why it's a myth is capital raising it's a tool to scaling your business. So in as much as you raise capital successfully, it's a tool for you to scale or develop the business, and you can't just focus on just raising capital, because a lot of the time what happens is you have a lot of companies that focus on the capital raising aspect, and then they neglect developing the business fundamentals. So whether it's developing the sales of the business or controlling the cost of the business, they stop focusing on that and they focus on the capital raise. And then the business suffers, and then when they go to raise capital the next round, they run into trouble, because at that point, investors realize you focus so much on the capital, you haven't developed the operational efficiency of the business. So that's why I say that's one of the big myths, is that when you raise funding, it's a success and you've done it all. No, it's part of the journey to successfully scaling the business. So that's the first myth. I think, secondly, another myth that's out there is you have to attract to win over every investor. Not every investor is for every entrepreneur, and that's okay. So don't get down if you approach an investor and they don't invest you. There's investors for every SME out there. I think a lot of people feel the pressure that every investor that they go to, they have to get funding. That's not the case. Some investors have preferences, and that's okay. The key is knowing who to go after for funding and focusing your energy on them. Don't focus on going for funding from an agribusiness financier when you're in fintech. It doesn't make sense. It doesn't work. And when you fail, it's a given. So these are some of the things that investors need to focus on. I think, if you don't mind, a third myth is that raising capital is a numbers game. So what I mean by numbers game is investors are just focused on the financial or the numbers or the data of the business. The numbers are great to have to convince investors, but you also have to have a compelling investment story for why they should invest in your business. If you can't spin a good story as to why they should invest in your business, more often than not, you end up not getting investments from investors, even though your business deserves it, because they need to hear the compelling pitch as to why they should invest. And then you use the story to back up the numbers or the data. So when you're approaching companies for investments, pitch them, give a good story, but use the story to support your fundamentals. It doesn't make sense if you have a fantastic story to tell them, but your numbers are all over the place. So I think those are my 3 myths that.
Okay, so Barry,
Bring
just
up.
piggybacking off that, David,
Right.
I'm going to come to you. So we realize that a lot of the time, venture capitals, for a lot of us, we think that you're solely focused on the financials. You're solely focused on getting your money back and your money. How true is this? Do you feel like this is something that happens? And if it's not, what else are you looking out for?
Okay, thank you, Samira. I think that's probably the last thing that we would look out for. First of all, we have to know who are the people who are sitting in front of us. It's a management team that is coming to raise money. What's their pitch? What is the experience they have? What plans do they have? And do they have the relevant, experience to run the business that they say they are going to run? So we need to be convinced about the people who are going to run the business. Of course, then we'll look at the business itself. What's the value proposition that they are presenting? Okay, is the product that they are presenting attractive? We can say you're doing water, right? So you will look at your branding. Is it attractive? Okay, then we'll look at the market overall. So you want to get into the water business. There's Awake, there's Voltic, and all the many others. How are you going to position your water across that market? Right, because it's a huge market. Where are you going to fit in? The last one is then the commercial attractiveness. So we've looked at the product. Yes, it's a nice branding. We've looked at the market. Okay, there may be a position. But how about the commercials? How are you going to price, right, within the market that you are looking at? Are you actually going to make a profit? Right, so that's one aspect. We've looked at the management. We looked at the product, the company. Then the one block that we look at is just responsible business practices. Right? And this is where we'll look at the people and wonder whether they have some bad track record. Right? Are they people who are honest? Okay. The business, are there any red flags that have been raised against them? Right? Compliance, do they care about the environment? Right? You're doing water, where are you producing? We take a look at your factory and we see so much data, or even in your immediate environment, there's a big gutter which is quite dirty, right? And you're operating right by it. What have you done? So responsible business practices also come into place, right? And then the last one is, how are you planning? How are you planning your business finances, right? Are you doing budgeting? How are you forecasting? And how do you execute? So the last thing that we'll then talk about is what profits and when are you going to return our money? Because the truth is that if you have all these things in place, the likelihood that you'll be able to execute and give us a return then is much higher.
All right, thank you, David. So, Mr. Shakib, I'll come to you next. In your profile, we mentioned that you're an angel investor. And one of the myths is that angel investors typically invest exclusively in technology, which is a field that you focus on. Do you feel like this is the case for most angel investors? And if so, why? And if not, why not?
Sure. I think my experience is in technology, both in raising money for my companies and also in investing in technology companies across Africa. So yes, there's a lot of focus on technology and fintech has had, very good track record of attracting investments and showing results. But I think there's a whole range, in my experience, there's a whole range of investors, not only angel investors, who are looking to address problems that exist across our markets, and that can range from everything we've spoken about. So investors are very much focused on specific areas, and there are investors I know who are focused on transport, investors are focused on agro-business, agro-processing. There are investors who are only focused on technology. So it depends. So that's where the challenge of matching as a business, you have to know who is willing to invest in your kind of business. And likewise, as an investor, you only reach out to like-minded businesses.
Okay, so I think that my next question for all three of you is, what's some of the biggest misconceptions that you found businesses have when they're seeking investment? And we'll start with you again, Shakib.
Thank you. There are lots of issues. It's not easy raising money in our part of the world, as much as there are lots of people looking to invest, but matching the expectations on both sides is difficult. Investors are looking sometimes for unrealistic returns that do not exist in our part of the world. Our ecosystem is a lot more patient, if you can call it as such. It takes longer for us to get going and to become revenue generating, to become profitable because of the challenges that exist in our part of the world. It is tough operating any business properly. Okay, and likewise, I think the expectation also from businesses is just by having a fancy pitch deck and a good idea, they think that people should be ready to throw money at them. So matching those, I've talked about the extremes. Of course, there's everything in between. But matching those expectations, and then I think a lot of people also have very unrealistic valuations in mind. You know, I don't know where they pick them up from. You know, it's a bit unfortunate, but picking up, and so you set yourself up for failure, right? You think you have a wonderful idea, and it's very, it takes a lot of time and effort and hard work to build a team, to build a product, to get it out, to test it, and then slowly investors will come, or then you are ready to reach out to investors. So I think the basic issue is, if they can go hand in hand, is trust, right? Trust, there must be trust, basically, and then the expectations on both sides.
Okay, thank you. Barry, coming to you, just because he mentioned valuations, and that's what you do. So typically we have, in Deloitte, we have different businesses coming to us looking for funding. Right. What kind of things do you see around their valuations, and what are some of the misconceptions that they have?
All right, so I think one of the issues you see with the valuations is companies come, investors, the entrepreneurs come, it's their baby, it's their pride and joy. They think the world of it. So they come with, like he mentioned, come with very high valuations that can't be supported. Or when you look at comparable companies, your company's valuation is exceedingly high and there's no justification for it. Because a lot of people come, and because they're looking to raise capital, the focus is on, or the thinking is, investors want to see something big and splashy, so my revenue figures have to be amazing on all of them. So what does that mean? My forecasts are going to be extraordinarily aggressive or high, because I know that's going to give me a high valuation. But what people don't realize is when you're dealing with professional investors, they will sense check your forecasts and they have investment metrics in mind. So when they look at comparable companies that were probably at the same stage as your business is, if your valuations are many times higher than that, it's a red flag to them. And sometimes because entrepreneurs are so focused on raising funding, they just focus on, okay, how do I pump up my financials such that I get the biggest number I can, without realizing you have to be able to justify these figures. When an investor asks you questions about your financials, if you can't justify it, you're more or less dead in the water, because at that point, they feel that you haven't done the necessary market research to justify the valuation you're looking for. So I think that's usually a key issue we see with companies looking for investments.
Okay. And David, so with you in your field, what's some of the misconceptions that entrepreneurs have when they're approaching you for funding?
I mean, when I think about some of the entrepreneurs I've met along the way, you know, I smile. There are people here who own $5 billion revenue businesses, whose drinks are selling all over the world because their drinks improve your mental health. That guy is still taking trotro now. But a couple of years ago, he had a $5 billion business. He wanted to raise $30,000 from me for 1% stake in that $5 billion business. Okay, and he hadn't even drawn a product, but he had an idea, and that idea was already worth $5 billion. He was a very wealthy man, sitting in front of me. And if you see the way he was talking to me, you know, he was a very wealthy man. But of course, fast track 8 years down the line, he's still there. Right? Not a single CD raised, and he's not doing anything. A lot of people think that an investor doesn't know what he wants. Right? Most people think that there's this small man hiding in some computer somewhere who has a lot of money, who doesn't know what he wants to do with it. And when I approach him with an idea, he won't really interrogate me, and he'll give me the money, and I can spend it the way I want. You know, maybe I'll be successful, maybe I won't. But at the time, they believe in that, right? An investor is not a mystery person who doesn't know what he's doing, right? He's somebody who has worked hard for his money. If he's an angel investor, if it's a fund, they've struggled to raise money, and they want to return capital and raise more. So obviously, they will not just look at you and not interrogate you, right? These investors know what they are doing. Secondly, investments are different from grants. A lot of people are looking for a grant. They are not looking for an investment. So when they come and they say, we are looking for an investor, no, what they are looking for is really a grant. They want some money that they can use the way they deem fit, that they don't have to pay back. So most people confuse searching for an investor with searching for a grant. And that's another myth. Most people are grantpreneurs. Right? They are writing the next proposal so they can source a grant, hoping to impress some DFI about some social impact that they want to achieve, and they are trying to raise money. But they are not investors who are looking to raise money and thinking the way that, look, I'm setting up a business so that I can improve my family, I can have a better life, I can make a return. That investor has the same alignment. He's not there to give you money so you can become rich. He is there to give you money so you can do the work and both of you can become rich. Right? And that's the mindset that that's the greatest misconceptions I see.
Okay, so say I'm an investor, David, and I walk up to you. What are 5 red flags that automatically make you think, I'm not trying to give this person money?
Well, first of all, if you are not building a 5 billion and offering me 1% for my $30,000, so we're having a realistic conversation that is grounded in reality, right? Yes. And you know what you are doing. So within the first 5 minutes in speaking to you, I can have a fair idea if you know what you are doing, right? You understand the product you are offering. You understand, as Barry said, your competition. You know how to price, right? You know the margins, and you have a fair idea of what it will take to grow your business, right? Within the first 5 minutes, you can usually, determine that this is a serious entrepreneur who knows what she's doing before we even get into the many other things of what you've done before, etc. But within the first 5 minutes, you can convince me just by these few things.
Okay, I have a business. I'll see you after this. Shakib, same question to you as well. If I come to you, what are some of the red flags that automatically make you think,
I think, first of all, look, in any conversation, you get a good sense of the worth of the person, right? But then all the questions, especially is if there's any regulation required around the business, if it's around food, anything around land, look, already red flags, around pharmaceutical, you can see that there's a lot of effort required to go into those things. And then quickly, I think the question I like to quickly get into is recurring revenue, right? Is it a concept, right? Or is it an existing business? If it's an existing business, what is your current recurring revenue, right? Which you have to justify, which you cannot hide, right? Because bank statements is enough to tell us, but then when we look at your books, when we look at bank statements, the reality of that comes out. So quickly, yes, we all get a sense, having been in the business for so long, you quickly get a sense of what is a wish list and what is a real business, and then the character of the person, the background of the person. If one of my pet peeves is the expectation that someone coming out of university armed with a laptop can make a business. Okay, I think that it takes time. I've been in business for 25 years. I still make mistakes every day. So, so the expectation is that for someone to have gone through some work experience, to have learned the lessons of business before trying to start up something on their own. Yes, there are many people who will succeed. and God bless everyone. But in reality, I think the chances of a team, because I think Barry spoke about it. Look, raising money is hard work. It's almost a full-time job. So in the background, who's running the business? While you are out there talking to all of these investors, building your business plans, so how solid is the team? How solid is the business? Is it over competitive? Is it copy and paste? If everybody is doing shito and tomato paste today, where's the market? So where is that? So there's no one red flag, but as you have a conversation with the person or with the team, you get a sense of whether or not this business is worth investing in. Then you can move on to a more detailed due diligence, looking at numbers, looking at documentation. But I think within 5 to 10 minutes, you get a sense that is this a business worth investing in it or not.
Okay. So, Barry, I'm a business, and listening to David and Ashakib, I've decided, you know what, I can't do this myself. I've come to you, Barry. What are some of the things that I need to know before I come to you as an investor? Looking for you to help me to raise funding. So we're thinking investment readiness. What's some of the things that we as businesses fail to consider before we approach whether investors or advisors?
All right, so I think firstly, like Yao and the rest of mentioned, one thing that a lot of entrepreneurs tend to forget before approaching investors is the importance of good records. Like, we can't stress this enough, because when you approach an investor and they're interested in your business, you need to have good records, because if you don't have good records of your sales and your costs and your expenses and what you're doing with the money, it's a red flag to a lot of investors. So one is having good records of your financials, or even if you own any assets, have good record keeping of your assets. There's a lot of businesses out there, they may have land or property, but if you ask them to establish where's your title for the land, they can't give it to you. And sometimes with some of these businesses, you can use these assets to raise financing, but because you don't have sufficient title or documents showing ownership, that avenue is shut off to you. So I think that's one thing that investors need to be aware of. Secondly is entrepreneurs need to be very good at articulating what's their drive, what's the purpose for the business. A lot of entrepreneurs will go into pitches and be like, oh, my name is this, I want this money, this is what I want to use it for. There's no passion, there's no drive about what they want. And if you're not excited about your business, how do you expect investors to be excited about your business and invest in you? So sometimes that part is lost, because entrepreneurs will focus on the money part. But you have to pitch and convince investors to invest in your business. How do you do that? It's through enthusiasm and drive. An investor will never invest in you if you come across as dull or monotonous. Why would they want to do that? It's the same way you don't buy products or services from companies you find boring. So that's something that companies also need to be aware of. I think a third thing is, when you're approaching investors, especially for entrepreneurs, a key concept is you have to be able to demonstrate that your business is scalable, which means it can grow with investment multiple times, that there's an addressable market that your product or service is tailored to, and that you've done some assessment of the demand for your products and services. So if you're armed with these figures, then it makes approaching investors much easier. Because you can't approach an investor and say, oh, I think this market is worth 100 million. And then when people do the research, the market is only worth 10 million. So there's automatically a mismatch. And if an investor thinks you haven't done proper market research, then they're not going to invest with you. So there's that premise that you have to have done your market research and be prepared for any questions or feedback you get from investors. It's not when you approach the investor and you're asking for money that you're now thinking of answers on the spot. So sometimes I think entrepreneurs, you can prepare yourself for these investor engagements, have discussions internally or with friends and family about, okay, this is what we want to do. Get feedback on, this is what you're doing well, but how do you address A, B, C, D? So that by the time you approach investors, you have answers for them. The last thing you want to do is approach an investor and they ask you, how do you plan to do this? And you're there, You're busy chanting to them because you can't give them an answer. You do that and you've lost them. And with investors, a lot of the time, it's all about first impression. So if you get the first impression wrong, it's usually very hard to go back to the investor later and try to get money. So those are some of the things I think off the top of my head.
Okay, so I'm sensing a running theme. I mean, David, you mentioned, you could tell in the first 5 minutes, Barry, you as well, first impression, Shakib, you as well. So for you, David and Shakib, as investors, what are you looking for in the first 5 minutes? How do we pitch a business to you?
So I guess at the risk of repeating myself, you come to me, you need to tell me what you are doing. Okay, you're offering a service or you're producing a certain good. You need to tell me what you're doing. Show me what you're doing. If it's a good, you show me. If it's a service, you're telling me. Or you can describe it in a very short sentence, what you're doing. That is catchy enough for me to, to catch my attention that, this is something worthwhile, okay? And then you need to tell me how you're doing it. Okay, so you're producing here or why, okay? And this is the need or a problem that you are solving. Okay, so this is a problem you've identified. It's widespread enough. The good or the product or the service that you're offering is meant to address this particular problem. And the size of the problem is good enough so that people will pay you for the good or service that you're offering. And if people are paying you for that, you are going to be running your business, effectively or efficiently so that at the end of it, you will make a profit. So I'm building a certain kind of structure here, which would typically be in a pitch deck. Okay. So you're telling me, you're setting the scene for what you do. You're setting me the scene for the markets that you're operating in or the problem that pertains in the market. You're setting the scene for the solution that you are providing to that problem. And you're giving me a sense of the size of the market and the size that you yourself, can address, right? And then you're telling me that you can price very well and you have people who have already started paying you for the solution that you are providing. It's important, Sakib mentioned it. We want to see that you have generated traction. Yes, unfortunately, in our part of the world, people say you need to show traction first before you get an investor. It's unfortunately the kind of risks that our investors take here. In other markets, you need to show an idea, and people will throw the money at you to go test your idea. Right? Here, we don't have that kind of idea testing capital. Well, obviously, maybe because we are also not that wealthy, and we don't have too many entrepreneurs that have made money out of people who gave them idea capital, right? So we are not there yet. Maybe the wealthier we become, the more likely we will find capital that backs ideas. But for now, it is capital that backs traction, and that is what we have. So you should have started, bringing your product to market in your area, offering that service to a few people, and we should see that people have started paying you for it. And there's some cash, coming in, and you can prove that you actually have received some payments, from people for the service that you are offering. And then beyond that, we can see that there's this number of people who are also would be interested in patronizing your good or service if they know that you are in the market. So that is your growth. That represents the growth that you can achieve. And if we believe, or you've convinced me in those few minutes that these people will actually continue to pay you for the product that you're offering, based on the evidence of the first 10 people you've served, then you've caught my attention. I can now start asking you, so how much money do you need in order to be able to service the rest of the people that you are targeting? What other capex or what other equipment do you need to buy in order for you to produce more so more people can buy? What do you need to spend in terms of marketing, right, for all these people to know that you are offering this good or service? Then we can begin to get into that kind of conversation. But for the first few minutes, if you've structured your conversation with me in that way so that I can immediately see a good product solving a particular need with a huge market available that can be tapped with the right support, then you have my attention.
Okay. Shakib, anything to add?
But maybe to add, maybe I'll go the other side. David has spoken about the head and the numbers, but also I think it's the emotional part, all right, without getting carried away. It's the trust and confidence. In sitting across the table with someone, well, how much trust, does the person generate or the team? So is that experience, the background of the team or the person, the experience they have, the track record they have, what references you can get on that person. Because yes, the numbers can all add up and everything can look fine, but you give money and the person goes and buys a nice Mercedes and, it has happened many times, So So yeah, so it's finding that right balance also, having a good business plan, but also having trust and confidence that the team will execute that funding when it is received for the purpose for which it was delivered. So that's where we are challenged in getting that track record of the persons, what background they have. And I do wish, if we slowly built up a track record of saying, listen, there's a team coming out of this university with an idea, yes, there should be funding available. We do have so many problems that technologies or other, no one else can solve for us. Our own homegrown problems, only we understand them, only we can solve them. But unfortunately, we're not yet generating enough. And some of that is because of, again, the macroeconomic environment. If treasury bill rates are high, why should I risk my money with a young team who can just disappear? So there are a lot of factors that really have to, a lot of people are making effort, but I think we all have to work together to make it more interesting for entrepreneurs to raise money to fund businesses.
Okay, so we have quite a number of questions online.
You wanted to say something?
Did you want to add something, David?
Yes, sometimes when we talk about things this way, some entrepreneurs feel discouraged. They feel like it's such an arduous task to raise capital, right? But it's not. Maybe we can talk about the many, many entrepreneurs that are raising capital, on a regular basis. I mean, I work for GHISP, which is BI funded, put up a fund with $50 million just to fund SMEs in Ghana. In the past year, we've done 9 deals, okay? And there are a lot more companies in the pipeline. So there are people that are actually going through this process, pitching, working with advisors who can help them, who are raising capital. So it's not something that is too far-fetched. It's something that people are doing now. They are raising capital successfully. So nobody should be discouraged. You should only get discouraged if you don't know what you are doing. Then go back to the drawing board, build out, a proper case. Because from where we sit, there's a lot of money that we are looking to deploy into SMEs in Ghana, and we are not finding these SMEs, right? So don't be discouraged. Just go back to the drawing board and pitch, structure your pitch properly.
David, it's actually very interesting that you said that, because one of the first questions that I was going to ask you, so an anonymous attendee online says, I get the feeling that investors are only looking for the perfect business, well presented, well structured, almost flawless. Does this mean only those projecting a spotless image stand a chance of being financed? If so, when can we talk about investors taking risks, and what kind of risks are we talking about? Loaded question.
I preempted the question.
Yes.
It's quite loaded. Well, so, there are different tiers of investors. Okay, there are those who would come in at the angel stage, right? Will back you maybe with just a little traction and help. They have experience, so they'll help you grow your business. Help you if you have a decision to make, you can bounce it off them. They will give you guidance because they've made mistakes before. They know what you can avoid. They can give you very quick capital, right? As you grow, then you can get into the venture capital stage. And venture capitalists will take a little bit more risk. We don't have too many of them, but we have them. We've got these accelerator programs. Some are DFI funded. They've got quite a few of them in the market. So if you are starting your business, look, find some accelerator, associate yourself with them. Be in the business of the places where there are hubs, there are discussions around money making. You are sharing stories. You're sharing resources. If you get into that space, that place, capital available there takes a bit more risk, right? Before you come in and talk about private equity, people who are, in the markets, lots of them. Of course, the CD challenges have, maybe made them stay away a bit. But a lot of them are backing entrepreneurs with huge risk, right? Huge risk. And they come into your business, help you, structure your business. If it's marketing, if it's sales, they help you build it up. So every day, I can assure my anonymous that every day there are people in this market that are assessing businesses. Every day we get businesses, pitch decks and other things thrown at us from companies, from advisors who are looking to raise capital. And every day we are screening. And we don't look for the perfect business. Actually, in our program, we look for gaps that would, so a company is not investor ready. They come to us and realize that, look, they could do a lot more on their financials. We don't say, no, we don't want to invest in you. So long as you are on the growth path, we say, why don't we help you to fix your financial or accounting problem? or your governance problem? Or why don't we help you? Because we identify that you don't even have an environmental and social management policy. You probably never even have heard about it. Right? But that doesn't mean we won't invest in you. We'll find someone who will work with you to build that up till you become investor ready, and then we match you to an investor. So there are programs like that in the ecosystem which will help you. So we shouldn't be discouraged. We don't look for the perfect business.
Shaki, what about you?
Oh, same. I think there's no perfect business, but at the same time, an investor wants to be sure that their risk is managed. So I think Barry also spoke about it. We've seen that a lot of businesses, their registration forms are incomplete, out of date. So if your basic company registration is not properly done, you don't know who the directors are, you don't know who the company secretary is, your annual accounts are not filed, sometimes you have issues with taxes. Of course, we don't want to come in and then, become liable also or find undeclared liabilities, and waste our time and effort. So it's a balance. Yes, we want to minimize our risk as much as possible, but yes, we're looking for opportunities. And opportunities only come about when there are gaps. So I think the other thing is humility to some extent, right? If you are humble enough to accept that I know where I am and I'm looking to perfect myself, I need your help, then yes. But like David said, if you come with a valuation straight away, then why do you need us? Good luck. So it's finding that right balance. Like I said before, I think I'm in fintech and I see so much opportunity. Of course, even I'm limited. All of us, we're all limited in the money that we have and the teams that we have. So there's so much opportunity to bring people on board. And because we know that business, it's difficult to lie to us. If you come and tell us that, I'm going to be the next MTN, or I'm going to start a new neobank in the country, you don't know the regulations, and you don't understand, the cost of customer acquisition, then it's not going anywhere. So it's finding that right balance to say, listen, there's a current gap, we want to address it, and yes, there is a chance that we will hit a dead end, but the possibility that we will keep on pivoting until we find the right opportunity. So that's what I keep on saying is the trust and confidence. The business plan may be good, the company setup may be good, but the trust and confidence that we're investing in the people, we're investing in the CEO and the team, who, when they hit challenges and they hit roadblocks, will figure out how to resolve those issues and keep the business going. That's the real perfect scenario that we actually look for.
Okay, so Barry, there's a question for you specifically. Lovetta would like to know, she says, Barry mentioned that investors look out for corporate governance. What specifically are they expecting regarding corporate governance? Again, are SMEs too small to have boards? I think it can go across all three of you because you've mentioned the people behind the business quite a bit. But Barry, we'll start with you.
Okay, so I think when we talk about corporate governance, one of the signs is having a board of directors who help to oversee the management of the business and make sure the business is performing the activities it's supposed to. So no SME is too small to have a board of directors. We work with clients where the SMEs, they have a 2 or 3 person board, which is perfectly acceptable. You can have a board of 2 or 3 people. Usually it helps to have, if you have 1 or 2 independent board members, so independent board members being board members who have no ties or affiliation with the business. So, because it helps them be impartial about how the business is run. It helps with the corporate governance, having structures in place to make sure the business is running well operationally and financially. These are things that you can start doing as an SME. You don't have to be a big corporate company to start doing or having these corporate governance structures in place, because investors place importance on it, because companies that have good corporate governance tend to perform better than companies that don't. The studies to prove this. So that's why a lot of investors will look for certain signs of good corporate governance. Again, if you don't have it, you can always start working on the structures before you reach out to investors. But that's why there's a lot of attention on corporate governance, because if the company management is not doing what it's supposed to or is misappropriating funds, for example, if you have a strong board, they should be able to pull that up and push action such that that behavior is stopped. Because there's a lot of companies where they get funding from investors, and then there's all types of misappropriation or fraud. And boards look the other way, and the fraud goes on undeterred. But you also have companies where the board of directors will pull up such behavior, suspend or fire staff who are guilty of, let's say, fraud or inappropriate behavior. So that's why corporate governance is such a key issue for investors. So to answer her question, SMEs are not too small to have corporate governance structures in place. You can start building them, and then as you develop, you can also add on to those structures. But
Okay, but I guess my follow-up question is, I'm a mom and pop shop, and I want to set up my board. Who am I looking for? I have a friend who has a similar business. Can this person sit on my board? Or what kind of people should I be looking for when I decide to set up my board or my governance structures? Maybe David.
I think that we also have to look at the life cycle of every business and be real and practical in our part of the world. If you start your business, a mom and pop shop, and you are selling, that is not the time you are setting up a board, right? Let's be realistic, right? You found a need in your area or community, you are setting it up. Yes, maybe you have plans to scale and branch out, but it is not in your first year that you are going to set up a board. That's never what you're asking for.
Okay.
But when you set up that shop and you have your own attendants and you have the people who supply you with your goods and you have an accountant and you as the CEO, how are you taking decisions in that company, in that small business?
But it's my business.
Yes, it is your business. Perfect. But if, for example, you are not there and somebody comes to ask the accountant, right, for his, the goods that he supplied 3 weeks ago, when is it due for payment? Will the accountant be able to say, yes, according to our schedule, you are due to be paid next week? Or is it all sitting in your head and you are moving around with it? That's where the governance starts. So even the team that you work with, how empowered are they when it comes to decision making? Is it transparent? Okay, because maybe the shop attendant who even takes stock of the goods that come from Unilever and others knows that there is a schedule. She knows when it is due to be delivered. She even knows when they are due to be paid, and the accountant to make the check available because she understands the decision making in that small business. So that person is so empowered and knows so well that if one of your suppliers comes in before time, they can tell them that, oh no, you will be paid next Thursday. Because she knows she's part of the decision making. There's a transparency that has been. If you start your business that way, you are more likely to have corporate governance later. Because you listen to your shop attendant telling you, madam, the thing is getting finished though, so maybe we have to reduce the turnaround time, how often they supply us. Because she's part of the decision making. It means you started listening to people. You're already listening to your employees. Your accountant is telling, oh, madam, the money that you took out last Saturday, that one was not accounted. Can you bring it back? So if you, yes, oh, sorry, then I bring it back. It means you started listening to your accountant at that very early stage. That is what governance we are talking about. That's what we refer to as corporate governance. Because you have started well. It's not having a board and holding a board meeting every quarter and presenting some fake numbers to them. They drink tea, they approve everything, and they go. Some people also have that, and they say we have corporate governance. No, there is no corporate governance. And a lot of boards exist for that purpose, to take a box. They go for meetings, they talk politics and sports. They drink, they say, oh, yeah, we approve. And then they go on. It's that corporate governance. So let's distinguish the two. Transparency in decision making, right? Where it's not one person who has all the knowledge and there's no soundboard and transparency, right? Versus, having people who are sitting there, on our website with a good profile. That's not what we're asking for. It's transparency in decision making. So tell maybe the answer to the question is not, corporate governance is not boards.
Okay.
And 5 people and where do I go for board members? No. It's transparency in decision making. So it starts right from day one, all the way up.
Okay, so somebody else would like to know, how can you run a business successfully without putting a face to the business or the brand? So if I came to you and you don't know the people behind the brand, are you likely to invest? Anonymous.
I don't know the people. So who is raising the money?
So I am, but you don't know everybody else behind the brand.
But
I
how
guess.
will I know the transparency in your decision making? Who is your accountant? Who is checking to be sure that you're paying your suppliers on time? You're paying, yes. Who is checking the compliance? I don't know. It's just you. Obviously, then there's a red flag.
Okay.
Right.
Okay, so I guess you have your answer. Another question somebody would like to know is, how can a business discover or create a unique selling point that will make it stand out, especially in an industry that is saturated, in order to gain funding?
But why do they want to achieve that in the first place? If there's an industry that is already saturated and the margins are low, why do they want to create a business in there and stand out? That would be my first question to the person. So why are you struggling to, stand out in an already saturated market? I mean, you want to be a new MTN, right? And you want me to tell you a sales pitch that will make you stand out to become the new MTN. That's a very long stretch, right? Why do you want to be the new MTN? That would be my first question to you. And how long do you think it will take you to become the new MTN? And the money that I give to you, how much is it going to change the market in your favor? So why do you want to do that in the first place if it's a saturated market?
Okay, so another question. Most investors usually have a ticket size which they would invest in. How can a business owner still raise equity capital when the amounts they are looking for falls below the ticket size for most investors?
Barry, I think you mentioned that matching your expectations with the right investor. So if you are not in the ticket size of the investor, why bother talking to him? He has told you that my minimum ticket size is 5 million. You are looking to raise 1 million and you keep knocking on his door every day. You are hoping that he will change. Why don't you spend your energy and effort looking for the investor that does 1 million? So if you are not in that ticket size, you are not. Right? Switch.
And the logic for that is if we have to hire Deloitte to do the due diligence, what is the cost of that due diligence to make it worthwhile? So that's why there's also a ticket size, because of the due diligence and the follow-up involved. So, and there's a whole range of investors. There's friends and family, then there are angel investors, then you have scale-up investors, and then you have large-scale investors. So it's very important to understand what stage your business is in, how much you're raising, and then find the equivalent investors to go with that.
Okay, so Linda Abugri would like to know, what would the best investment advice be for a startup? Where can they go for funding?
Where should a startup go for funding?
Yeah.
Okay. Again, depending on whether it's a startup that has traction or it's ideas, because some people just have an idea, some people have traction. If it's an idea, please, the logic is the 3 Fs, right? There's family, friends, and fools. It's a concept you have. Yeah. So start from the people you know. You went to school, your classmates, your auntie, your uncle. Tell them about what you want to start. Your brother. They are the ones that will initially back you to lift off the ground, right? Definitely. If you just graduated from university and have the idea, you to start doing some work first and start saving up your capital, right? And then yes, you may find somebody who just likes your name or just likes you for who you are or just believes in your idea and gives you money. That's the 3rd F, right? But that's how you usually start, right? It will be hard. Don't go to a bank, right? Or don't go to a big private equity firm and say I'm a startup, because they say they don't do startups. Usually, that's your first source of capital to build your traction. After you've built a little traction, that's when you can start, getting into the accelerator conversations, the hubs, where there's some capital, right? People who fly in, angel investors, usually go to these accelerators looking for the next big thing. So if those are the places you should go to as your next step, for a startup.
Okay.
I think just to add into that, so another source of investing, if you're starting up your business, is, like you mentioned, there's angel investors. So in Ghana, there's an angel investor network, Ghana Angel Investor Network, GAIN. That's one place you can look at. Secondly, if you can't access a bank because you're just starting out your business, you can always look for foundations or institutions that give out grants, like like you mentioned, look, some people are grantpreneurs. Go. Some organizations have a lot of grants. They don't have enough businesses to give the grants to. And a lot of entrepreneurs get frustrated because they don't know of the avenues that they can access. There's money sitting out there, but you need to know where to look. If you have an idea, you can go look for a grant so that there's no pressure of getting money and having to pay it back while you develop your idea and develop your revenues. But like Daniel mentioned as well, you can also, friends and family, a lot of the companies, big companies you see today, your Facebooks, your Apples, your Microsoft, at some point when they started the startups, it was friends and family that gave them money. They didn't go to banks straight away. So it's perfectly acceptable to go and tap your friends and family for that initial funding. Then you can prove your concept to start generating some revenue. And then when you're ready to take the next step, go look for angel investors or venture capitalists. So those are the steps you usually want to take. Yeah.
Okay, Barry, somebody has a question for you. So it
Sure.
says, investment readiness. Sometimes investors require transaction materials, including IMs, business plans, etc., to be prepared by specific consultants, into bracket Big Four, which are quite expensive. How can business owners looking to make money be expected to pay so much for transaction materials when they are not even guaranteed to make the money back? And the second question is, how is a company like Deloitte helping business owners to raise funding at an affordable cost?
It's a fully loaded question. It's a good thing my boss is here. Okay, so in terms of how we help out with entrepreneurs when they're required to give all these transaction documents, we actually work with institutions such as UK GCC. We've also worked with MEST in the past. Deloitte has also worked with Access Bank, the SME investment series. So the avenues and the forums we have with these institutions to help SMEs develop and get ready to meet with investors, so that when they're ready, if they need assistance, they can come to us with those institutions, and we can see if there's something we can do for them. We won't say no. We'll always look at the cases or the merit of the case, and be there to assist, because SMEs are driving the growth in the country. So we have to find ways of making ourselves available to assist them. And it also ties in with what we said about Deloitte SME and Deloitte Private. So the ways that we look to assist SMEs when it comes to transactions and they need these documents, we're not turning them away. We're continuously looking for ways to assist them with that, and we've done that in the past, and we will aim to continue to do that into the future.
Okay.
Yeah.
David, what sectors does the GSIP invest in?
Okay, so the Ghana Investment Support Program is not an investor. So we're a program that is helping to direct more capital from investors or capital providers to SMEs. So we provide investment support. So we work with, and you didn't mention me, Barry. I'm very
Apologies.
We work with people, transaction advisors, including the Big Four, and Deloitte has been a very strong partner. First of all, to try and provide more quality but affordable transaction advisory services for SMEs, and Deloitte is part of the Big Four that is doing that actively for us. On the funding side, we have GIP, which is a fund that is also set up by BI, which has $50 million that is deploying capital to SME. So we also direct pipeline to GIP. So if we find a company that is not investor ready, and we are sector agnostic, if we find a company that is not investor ready, we can help to fill the gaps and make the company investor ready, so that GIP or other funds that are operating in the ecosystem would fund them. One of the other things we do is we are trying to get more funding to be released from pension funds to fund managers or GPs. So we're running a 1-year, training program for pension funds in Ghana, at the end of which they will increase their allocation to many of the GPs that are operating. We are targeting to unlock about 300 to 400 million. All that capital will be available to SMEs. And that's why we're working with transaction advisors, because we anticipate that once that capital is available, we should see a lot more deal making and matchmaking going on in the sector. More SMEs working with advisors like Deloitte on investor readiness so they can access the capital. So we are ecosystem builders at the Ghana Investment Support Program. We're tackling the access to finance problem at different levels. And we are sector agnostic. We don't pick and choose which companies we work for.
Okay. So Kennedy would like to know, How do investors weigh social impact against profitability in developing markets? Shakib, I'll start with you.
I think it's a very good balance. There are investors who think that by investing in Africa is all social impact, whether it's Flutterwave or anybody. And then, of course, there are people who are really monitoring to see what specific impact is being created, whether it's around gender, whether it's around climate, financial inclusion, right? There are all sorts of very specific programs that investors are looking to support. So it's only by being active that you get to understand where there's actual investment support for these programs.
Okay, David.
Yeah, I think it's a mix of both. When people talk about impact, social impact, it's not like it is far removed from profits. I mean, you cannot be profitable and be destroying the immediate environment. You cannot be profitable and be maligning your employees and insulting them. So the impact that we talk about is really tied to the way businesses are supposed to behave. So we just call it responsible business practices. Once you are responsible in your business, you end up being profitable. For example, why would you invest in a company that's doing galamsey? Right? You are destroying the environment and making short-term money. Obviously not. So in a business that is trying to be profitable, you need to care about the people you work with and the customers that you serve. That's all.
Okay, so another question we have from an anonymous person online. It says, most people think banks when they are looking to raise capital. However, business owners who are new to raising capital, especially equity funding, don't know where to go or how to identify the right investors. Can you help?
Okay, identifying the right investors. I think we have a deck. We can share that, which gives you a scope of the landscape of capital providers in Ghana. So it will show you the accelerators, the incubators, the fund managers, the GPs, and the sectors that they are looking at, and then the size, the minimum ticket size. We can make that available so people can learn where to go to. But I think it's a question that keeps recurring. So it's something as an ecosystem we should continue to make available.
Okay, and David, for you again, do you have any recommendations on corporate governance training programs businesses can attend?
There are many of them. I don't think any one comes readily to mind, but I see a lot of them being publicized. Well, I think Deloitte has, and since we are in Deloitte's home, we need to mention that Deloitte has a corporate governance program. Maybe if they go to Deloitte's website, they'll find information there. Yeah.
Okay, so David, this is to you, but I'll give it to Barry. If you're an employee in a company and your owner asks funds to be transferred to personal funds, what are the options for the accountants? So David, this is based on your example. Based on your example, what can an accountant do when the owner has asked you to send money to his account?
To his personal account?
Yes.
Well, if you are a professional accountant, and there are more than enough professional accountants here, you need to let the owner know, first of all, that, well, there's no policy or any principle in the books which allow you to take the funds. So, well, you are the boss, and you are taking the money out. So maybe when will you bring it back? Is this some short-term arrangement so that I can put some immediate IOU in the books so that you bring it back? Will you bring it back this week? Because, of course, facing reality, it will be very difficult for you to say, no, I refuse to transfer money because there's no policy, and then I resign, especially if you have a family to feed. So that's the reality. But trying to draw your boss's attention to the right thing to do is what you should do, I mean, as a first principle. But I guess there are better placed people here, auditors and accountants who can, answer that question. But that's what I would do anyway.
I think if it's your boss asking and you feel pressure and you have to do it, if you're doing it, document that you're transferring funds to the boss and possibly the reasons for the funding. Because if it's a mom and pop shop, that's fine. But the day you go look for investors and they see these transfers, they'll want to know what was the purpose for this. And you have to be able to justify or explain it away. Because if they think you treat your business like a piggy bank, no investor is going to want to invest in your business, because the first thought is going to be, as soon as you give them X amount of money, he's just going to start making withdrawals. And like Sakib was saying, he'll show up with a Mercedes-Benz one day. Next day, he's taking trips to Europe and such things. And you realize he's using your money. So documentation is very important for such purposes, and it helps keep owners honest and true, because if you know what you're doing there's records of it, then it forces you to be more honest about your intentions. And if you take money out, it's probably an incentive as well to return money into the business, because someday when you go looking for money, someone's going to come and ask you, have you brought this money back? If you haven't, why should I invest in your business when you yourself are taking money out and not returning it back into the business?
Okay. Shakib, this is for you. Are there investors who invest not for financial return but purely for social impact? In other words, they may not get their money back, but the positive social impact could be tremendous.
I think that that's a grant, right? That's a grant. If you're looking for, as an investor, I'm looking for everything. Okay, I'm looking for profit, but I'm also looking for impact. And I don't think those are mutually exclusive. It's possible to do everything. It's possible to have, yes, it may not be massive profit, it may not be, but there should be a reasonable profit that will make the business sustainable, that will pay for good employees, for good technology, for good infrastructure, serve customers in the best way possible, give back to the community, but still give a return. So that's the balance. Otherwise, yes, you can find grants who will support you in many, many ways. But even I think the grant areas is drying up a bit, with Trump making some changes, So I think everyone has to be very careful. Maybe the days of grants, are not as positive as they used to be. But for sure, a good, solid business which is socially responsible and balanced will attract investment.
Okay, David, 2 questions for you. What advice would you give to entrepreneurs seeking capital in sectors that are not traditionally hot for investors? And then the second one is, what are the top 3 things you as an investor would look for before you invest in a startup?
Okay, so the first one is about sectors that are not hot.
Yes, trendy.
Well, but I guess there are buzzwords all the time. There was fintech, there's AI and everything. But every investors also are grounded in reality. So if there is a sector, so long as you can prove that there's value and there's growth and there's a financial and potentially social impact return, investors will take a look at it. I don't think investors, and for most of the funds I see here, a lot of them are sector agnostic. Of course, there are some that will look at essential service or agribusiness, but most of these funds are sector agnostic. There's usually an exclusion list, but most of the other sectors, once you can prove that there's a financial return, I'm sure people will be willing to look it up. I think the top 3 reasons to invest, I think I've gone over it a lot of times, right? So maybe the question came in later.
Okay. Okay, so for Shakib, this is for you. It says, is your interest in technology driven by its potential to create billionaires overnight? And do you believe that there's a possibility here in Ghana, or do you see it primarily as a tool for meaningful transformation?
I think we live in the world of technology today, so it's impossible not to apply technology to any sector we are involved in. It's like air today. You cannot do anything without technology. And that's what, my background, my education in computer science from the University of Ghana, and my early interest in technology is what led me to become, if you can call it, an expert in that area. Not really in technology, but in applying technology to solve problems. I really can't code. I can't, assemble a laptop. I have no idea how a phone works. But I'm very interested in seeing today that a phone or a laptop, how is it used to help a farm or a small business? How is it used to help a hotel improve their visibility to their market? So that's my interest. I don't think we will ever make billionaires in Ghana just because our market is just too small. Billionaires are generated by the Silicon Valley ecosystem and by very large markets. So yes, Nigeria, Egypt, South Africa have the potential in Africa to generate those kind of billionaires. And yes, anything is possible in Ghana also. But I think primarily my motivation is to solve problems, using technology to help make the world a better place, and we'll make some money alongside.
Okay, Susan would like to know, do we have a regulation that ensures that grant-funded ideas that are do we have a regulation to ensure that all grant-funded ideas are guided and followed up on, I think? So I guess, do you have a
Also,
way of checking if the money is
institutions
used?
that
Yeah.
provide grants will usually, yes, they have mechanisms for checking. They will probably have a program manager that follows through. And even the grants can be maybe provided according to milestones. So you've got to deliver before, the grant is given. Sometimes you also need to match. So yes, there are plans in place or monitoring mechanisms in place to check that.
So with a lot of the grants as well, yes, it's free money, but there's criteria, there's strings attached. So there's usually criteria in terms of who can access the grants. And once you do, like David mentioned, there's reporting that you have to do to show what you're using the funding for. It's not just a case of get the money and use it for whatever you want. They track the spending because for a lot of these grants organizations, they have to account for the money they give out as grants. So it's important for them to track what the money is being used for. Because if it's a national grant, let's say for a country, that's taxpayers' money. They're accountable for what the taxpayer money is used for. So if they give money to any Tom, Dick, and Harry, and they don't account for what the money is spent for, it's not a good use of taxpayer money. You can upset citizens, and then what happens is you have funding for such grants reducing. So usually, to guard against that, they will always want to track what the grants have been spent on, because they also want to show the social impact that the grants have. So there's always going to be a mechanism for tracking that expenditure. It's not just a case of get the money and spend it on whatever you want and nobody checks in on you. Yeah.
Okay, so we have another question here. I guess it's a chicken and egg situation. It says, how do you handle a situation where you need funding to get growth? Example, the cost of raw materials is high. However, getting closer to raw materials will require relocation, which will give you a competitive edge and deliver profits. So I guess it's an issue of you need money to make money. So how do you handle such a situation?
Yeah, that's the magic of creating a business. If it was easy, everyone would be doing it, and that's the job of the CEO and the team or the founder to figure out how to create a virtuous cycle, right? By starting small, starting somewhere, doing something, and getting going. And once you start, then there's a good chance that you can get someone to follow you and support you with additional funding. But I think the important thing is to make that first step yourself. You have to start something before you can get anyone to follow you.
Okay, so the question that I have is, how do factors like market validation, competitive advantage, and a clear exit strategy influence your decision to invest? David?
Well, if you have that, then the better. I mean, if you don't have it, we can discuss how you can get it, how you can become more efficient. But if anybody or any company comes to raise investments and they already have that, I guess that's, top candidate for us, right? Yeah. But of course, it's important because these are key drivers of any business, right? So if we assess a business and we're able to tell that they are competitive and we see the growth path and the execution capability of the business, then I guess their routes to capital is maybe shorter, right? But those who don't have it, it doesn't mean once you're operating in a market that has potential, we can then help you with, putting together a proper execution plan, assessing your market competitive, and positioning your brand or business properly. Once you have, you're operating in a growth sector and you have some traction, that can also come in.
Okay. Shakib?
I think for my experience is that exits are difficult. There are not too many mergers and acquisitions happening in our part of the world for whatever reason. So the important thing for a business is to see a point to profitability and sustainability. That's the important thing. If then an exit happens, great. So having all of those plans in place is very nice, but the more practical thing, in my experience, is getting to profitability.
Okay. Barry?
I think just to add on to what they both said, so Those three are probably the most important factors because if you can demonstrate there's a market for your product or service, investors will listen to you. It doesn't have to be there today, but if there's a path to potential market, you have their ears. Secondly, that potential market, the product or service that you as an entrepreneur have, if there's competition, how does it stand out? You need to be able to articulate that to potential investors because more often than not, it's not, you will have competition with your idea at some point. I think like we mentioned earlier, Ghana environment, a lot of people, as soon as you see a successful business, there's a lot of copycats. Imitation is a serious form of flattery. So sometimes when you do something very well, you will get copycats. When you get those copycats, how do you as a business stand out so that your product or service is still delivering value? Then thirdly is the exit opportunity. So with a lot of investors, when they make an investment, it's with an eye to the future when they expect they can exit the investment, whether it's sale of the company or somebody else buys their shares. So for a lot of entrepreneurs, as you're developing this strategy, you need to have an idea about, as a company, what's our exit strategy for investors? If they come in, do we see an opportunity for them to exit in 3 years, 5 years? You don't necessarily have to stick to that, but as long as you have a strategy, you can always change it. But investors want to see that, okay, you're thinking about exits because at some point they want to exit and make their returns. So it's something to keep in mind when you're approaching investors.
Yeah. Okay, Kennedy would like to know, how do you balance investor expectations with staying true to your business vision? David.
Well, first of all, you sell the vision to the investor before they come in. It is rare that an investor would come in and say, change your vision. The reason why they invested in you is because of what you presented, right? So it's usually rare that an investor would come in and change your vision. So once you've articulated what you want for your business and where you want to, get to, the investor just comes in and tries to be additive, right, towards the vision. It's very rare for an investor to come in and say, hey, unless it's 100% buyout. Right? But if they are coming in to be a minority shareholder and to back you, they are not there to change the vision. It's very rare.
Okay, so a follow-up question. How does an entrepreneur deal with situations where the investor comes in and tries to out the funders of the business?
There are two things. They can oust you as a CEO of the business or as a member of the management team if you are not performing. And there's absolutely nothing wrong with that. But they cannot oust you as a shareholder of the business. And sometimes we need to distinguish the two. I've had several conversations around this. So I set up my business. I ran it for 3 years, right? Now it's a technology business. Now there's AI. There are so many things I have no clue about. And when I'm being presented with AI projects and proposals, I cannot, take a decision. And my board thinks that, hey, I've done a good job in the first 3 years, but given where we want to go, we need somebody that is more, aligned with the trends and expertise to take the business to the next level and to be able to expand it. So they ask me to remain on the board, and then we bring in a CEO, right, who can then take the company to the next level. But I'm still retaining 70% of my business. Why should this be a very big problem for me as a CEO? But people can approach it differently. How dare you tell me, why I should move, right? I'm the one who set up the business. What do you mean AI? For somebody to come and write the checks. You understand? So you can approach it from an ego, an emotional perspective, which means that the investors have ousted you. Or you can approach it from a rational, proper business perspective and say, when I step aside and go on the board, this new person will have a mandate to grow the revenue of the business from this to maybe 10x by expanding to other countries. And that's the mandate we have given him. Now, if we grow that revenue and we get to dividend payments, who takes 70% of the money? It's me. So you can also rationalize that and take that decision. So nobody can sack you as a shareholder of your business. Nobody can ever do that, right? But if you are not the best person to run the business, that is not a hard conversation. And if you are rational, you should be able to take that. But again, it's very rare that these things happen. Because most of the time, the investor would have looked at you, looked at your expertise, looked at your vision, and then come in to back you. Most of the time, that's what happens.
Okay. Shakib?
I think it also depends on the agreements in place, the shareholder agreements. Have you been diluted? You know, your employment contract, because that's completely different. The shareholder agreement is completely different the shareholder agreement is completely different from your employment contract. You know, and if you're the majority shareholder, you may appoint the board, and the board may fire you, but then you can fire the board. You know, so you can have a lot of drama around all of this. But I think the important thing is also so it's open to many interpretations or circumstances. But I think the important thing is maybe for the founder also to know their place in the life cycle of the company. There are people who are good at starting companies but not good at running companies, right? So once a company becomes stable, you know, then you may be more interested in going to start your next idea rather than getting caught in having an operational role and then taking the company on a much more stable and organic path. So it depends. There's so many factors here, but basically you need your lawyer to give you advice.
Okay, and so for Barry, what are some alternative funding options for a business that may not necessarily meet the investment criteria just yet?
Okay, so some of the alternatives that are out there in our market, one is you can lease. So if you want to get some financing, you can lease equipment so that you don't take ownership of the assets, but you do pay fixed fees to a leasing company to get the right to use the assets so that you can grow your business. Secondly, you do have what they call this peer-to-peer lending. So where institutions or individuals come together to lend to individuals or businesses. So it's a growing area in Africa. It's not that well developed yet, but it's an area that's up and coming in terms of alternative financing. I think the most prevalent one that comes to mind is factoring, where as a business, if you generate invoices, you can sell the invoices to a factoring company at a discount so that it frees up cash for the business for you as an entrepreneur to inject back in the business and to grow it, while the factoring company then goes and chases the debtors for payment. So there's usually factoring, which I think there are a few factoring companies in Ghana, but it's a good way for entrepreneurs to free up cash in the business so that you don't have to worry about chasing your customers for payment. You have the cash readily at hand and you can expand quickly.
Okay, I think the final question that we have here, so after all of this discussion, I've come to you as a business and you've decided not to invest. What's next? What do I do as a business if I'm rejected by an investor? David?
Well, your day-to-day job is to run your business. And looking for an investment is also, it's part of your growth plan to get in additional capital and to grow. If you get rejected by one investor, it doesn't mean that the business ends. It's like going to close a sale and you are not able to. The customer decides not to take up the service. What do? You move on and you try and improve your product and go back, and try and close the sale. It's the same with investments, okay? If one investor turns you down, it's not the end of the world. You may want to also ask for reasons why, right? It's usually important to get feedback. And the feedback is what can help you to build on. Maybe you don't meet their criteria, that's fine. Maybe they don't like, some part of your management team. If they give you feedback, that's fine. Maybe they feel your product is not attractive enough and you should go and, refine it or take another look at it. Then you can come back and use the feedback to develop a new plan, change if it's a team, or fill the gaps that they gave you, and then go back into the market. If you then meet their criteria, then you go look for another investor that is possibly looking at your area and has a lower ticket size. But getting rejected by one investor is not the end of the world, right? You keep at it. Rejection is not the end of your business. You keep at it. And an entrepreneur, you need a lot of grit anyway, especially for our part of the world, right? Even the banks are failing, so running a business here is tough. So you need the grit. You don't give up because you've been rejected by one. You keep on. Yeah.
Okay, so I will give a chance for 2 questions from the room. Cheryl, can we please have a microphone? Okay, so 2 questions. Please introduce yourself.
Can I stand?
Yes, please.
Okay. Can I be heard? My name is Shadrach from the tax department of Deloitte. GSS, Ghana Statistical Service, they put out a report that almost 90 or more than 90% of businesses in Ghana are informal. Are investors like you or the program you have, David, interested in these informal sector businesses, and what parameters do you look out for in supporting informal sector businesses? Because they make up most of the businesses we have here, and then they take up most of the workforce. So are investors looking at this angle too? And what support services can we all provide, at least, that will help them? Thank you.
Thank you. Well, I think it's a question that is, I guess, starting from the government all the way down to us as practitioners. That huge informal sector. First of all, how is it measured? Are we,
Taxed.
how is it taxed? Are they contributing the right, numbers to GDP? Are we capturing all of it? Right. Of course, we see the formal stats and we see the cash inflows, and you wonder where all that is coming from. So it's a big debate, right? I think there's complexity economics right now, right, which is trying to deal with, the all things are not being equal conundrum. But for us, as a fund and as people who work, to direct funding to SMEs, if you are informal, it's a bit difficult. For example, if you are not registered, you don't have a legal entity to start with, who are we dealing with? It becomes a problem to deal with the informal sector. So the work to bring to formalize these businesses is something that I think some have tried to do. I think some of the GEA and Ghana Enterprise Agency work and others were trying to formalize some of these businesses and trying to lower the barriers at ORC and others so they can be formalized. But for us, it's a bit more difficult to assess an informal business. If the business is not registered and is not keeping records, does not have a bank account, is not trying to prepare financial statements, it's a bit more difficult, at least from where we sit. So we will probably come in at the end of where the programs that are trying to formalize these institutions come in. So the GEAs of this world who are formalizing business, getting them registered, giving them some grants to register, trying to formalize them, giving them business support services. Once you are done with that and we can see traction, that is where we can then pick up, right, and then carry them along.
Okay, there's one more question.
All right, okay, thank you. So my name is Danosu. So my question is, I think we're talking about businesses that, people that are already in business. The biggest challenge we have in Ghana, I will put it as unemployment. So you have tons of people leaving schools and not having jobs to do. And maybe, I don't know who this question is going to. How do I start? So you talk about people having ideas. So there are a lot of people who are maybe watching us, listening to us. How do I start? What can I do? I mean, basically, before I even get to that point where I'm looking at maybe support or, because for me, I think that's a big challenge that we have, whether it's in the technology space, whether it's something that we will get to that we will need you to support. But there are thousands of them that leave schools every year. What advice would you have for such group of people? Thank you.
Okay.
I think we'll take the second question before we answer. Oh, there's a few questions. Okay.
My name is Theo Aithiajan. I just want to ask, I know to you, David, I know maybe a lot of entrepreneurs are come to you to seek for funding. I just wanted you to give us maybe one success story that you've had that you can share with us.
Are there any more questions? One more, two more.
So my name is Jacqueline Ruby Sakite, and my question goes to Deloitte. I would like to find out, an SME like mine, what will it take for me to prepare myself for an investor? What will it take? What does it involve in terms of how much will it cost me? What will it take for me to get prepared to meet an investor? Thank you.
Okay, the final question. Okay, so the panel will be around after, because we're running out of time. So we'll take 2 more questions, and then we can still have a discussion after, if you have any more questions.
Okay, my name is Thelma from Portmenter. And my question is more like a follow-up to what Mr. Usu asked. My question is, at what point do I decide that I need investment? Is it the ideation stage? Is it when the project has already kicked off? So at what point is it advisable to seek investment? And what would tell which kind of investor I go to? You know, what project would advise which investor I go to? Do I go to an angel investor or which, yeah. Thank you.
Okay, David, Sudan's question
Thrown
first.
lots of,
I'll go through them for you, no worries.
Yeah, that's fine. Okay, so maybe let me start by attempting to answer Mr. Usu's question. Where do I start? Okay. I think that we should, first of all, then be teaching entrepreneurship at a broad level in the universities, in addition to whatever course you are studying. Because you could be a good engineer, you could be a good lawyer. It does not make you a good manager of a business. And so starting means that you need to understand some basic principles around how to run a business, which most people don't have, right? So you graduate and you say, I want to set up a business. There are so many mistakes you are going to make, so nobody is going to give you that capital. It's something that I think we need to also then admit, that where you start from is getting some basic experience, right? Or what I'd say, coming together to form the capital formation, right, first of all, and then technical also formation. So that is where 5 people who have left university, who are not working, come together to form a business idea, team up with somebody who has a little bit more experience and capital to start a business, rather than everybody trying to go solo. So how do we encourage a lot more people to work together? Because that way we reduce the risk and also improve the chances of success, because then there's more people working together. But again, on a broad level, I guess I also subscribe to the view that to solve our unemployment business, it is not only creating new businesses, but it is about creating bigger and larger businesses within the country. Right? If we have one big, large business process outsourcing company, for example, that can employ 3,000 people easily. It's a competitive advantage, for example, we have in Ghana. We've got ESAL, right? Quite small, looking to expand, looking for capital. It's one of the businesses that we've invested in anyway. That business can easily employ 3,000 people if we had support for it. Why? Because we all speak good English in Ghana, right? Very good English. We have a very good time zone, and we have a lot of graduates. And all over the world, people are outsourcing BPO services to India, to Pakistan, to Sri Lanka, whose accents sometimes may be stronger than Ghanaians. We have that competitive. What can we do? If you create one big business, 3,000, 5,000 people, that's one. How many people does MTN employ? But how many big businesses can we then create that contributes to the employment? Because out of that, you then have people who work for 5 years, build experience, build capital. They are the ones that are more likely to succeed if they set up a business, rather than the fresh graduate. So I subscribe to big business, capital formation, pooling together, right, and then educating people right from the university stage, to grow. So that's my attempt, to answer that question.
David, next question was for you as well. In 1 minute, a success story.
Many. Okay, I guess let me just use some of the recent ones at the Ghana Investment Support Program. I think I can mention the name. Eden Tree is a company that has been in business for many years. But it will surprise you to know that for the investor that was looking at the company, Eden Tree couldn't meet the revenue targets of that investor. Right? So what did we do? We said we have to improve that company's sales. So we went in there, looked at who they were selling to. They were only selling in large supermarkets. We said, look, it's time for you to scope out and sell in the smaller supermarkets in the new peri-urban areas. So we got a consultant, scoped out what is the right kind of shop that can take in Eden Tree's products. I think we found out that the shop must have a fridge, right? So shops that have fridges, that have backup, because if the lights go off, fruit and veg is going to. But so the first question is, are these shops available in these communities? We went around and found, oh, there were actually a lot of them. So, okay, can we get them? Can we put fridges in these shops that stock products from Eden Tree? So we found a lot of them. We did the pilot. We found the right persona of shops, and then we started expanding. Within a year, they grew up to over $1 million USD in turnover, which then qualifies them to get the funding from the investor we are talking about. So that's a very good example of how we work. We've got some for a tilapia farm. We've got some from a light manufacturer in Kumasi. So they are real-life examples, many of them ongoing now as we speak. Yeah. And many success stories.
Okay, Shakib, when does a business decide that it needs an investor? At which point?
It's a very good question. It's a very deep question also. I think, ideas, everyone has wonderful ideas. The success factor is execution, right? There's no new idea in the world. Everything has been done and will be done. But your critical factor is, can you take this idea and make it executable? Can you get it delivered? When to look for funding, let's look at it from the investor perspective. That an investor is also looking for a return, right? The investor also has options. I can put my money in my bank account, I can put my money in the US stock market, or I can give my money to you. I want a good return. So the answer to that is some high return. Okay, I'm taking a risk, I'm giving you my money because I want a higher return than putting it in Apple stock or putting it in a bank account. So at what point are you able to, with some factor of safety, guarantee that by putting in this money, I can grow my business by a certain factor and satisfy the investor? So that's the equation we all have to think about, that when I take in my money, I'm maybe not an exponential return, but a substantially higher return that will turn my business around. That is when I think you're ready for any investor. Otherwise, then it's, if you want to start the idea, show off a concept, that's more friends and families again, who are really supporting you. And we need all of that also, right? But if you want to get in a serious independent investor, then this idea, at this point, you're either ready to make commercial impact or both commercial and social impact at the same time. That's when you're ready for an investor.
Okay. The final question, Yao, I will put this to you. Charles, can you please give Yao a microphone? So she wanted to know how Deloitte can assist in getting prepared for an investor.
Okay, I thought Barry was a plan prepared for this.
Yeah, 1 minute.
So we had mentioned our investor support services. So we have a series, of things that we do for SMEs to help them be investor ready. So first is transaction preparation. So we help you put your financial statement together. So within Deloitte, we have our BPS, Business Support Services Group, who can help you put your financial statement together, or in assurance business, we can help you put your financial statement together. And then if you already have that, or you have an accountant that is good at that, we can help you audit the account. And we have SME rates, like I said. We do not see all business are the same. Like we say in the local parlance, all fingers are not the same. And so you have SME rate that will help you do that. So that's the transaction preparation side, help you book up accounts, etc. We also help you prepare your business plan. It's called a bankable business plan. You go on the internet, you write something together, doesn't make it bankable. So as Deloitte, we will help you put that idea and vision together in what we call a bankable business plan. Closely related to the business plan is a financial projection or financial model. Investors want to see the future of the business in the next 5 years. And so we can help you prepare your financial projection or financial model. And then the other support services that we've done for a lot of businesses, and this is an information for all of you, we usually advertise for these events. So the Access Bank Deloitte program that we have for SMEs, we advertise for you to attend, and they are free. You just have to register to attend, just like this event. So these programs are available. Please do attend them. We take you through tax compliance, corporate governance, etc. So these are services that we have available for you. So transaction preparation, audited financial statement, etc. are things we do for you. Over and above that, please attend some of these events that we have, and you have the benefit. Thank you.
Okay, thank you very much, y'all. Thank you, panel. So I will give you 30 seconds closing statements from each of you. Starts with Shakib.
Well, I think last year I gave a talk. Bank of Ghana held this 3i Summit, and my talk was on why on earth did I become a fintech entrepreneur in Africa. You know, and I spoke about all the challenges I faced, all the fights I've had with shareholders, with directors, employees, regulators, tax authorities. And as David said in the end, I encourage everyone to follow me. It's a tough fight, but we need more entrepreneurs. We need to grow the ecosystem. There are real-life problems to solve. There are investors happy to support the real type of startups and scale-ups. And nobody will help us. We have to solve our problems ourselves, and we have to grow our own economies ourselves.
Okay, thank you. Barry?
I think, honestly, we've had this talk, and I think a lot of entrepreneurs will focus on the difficulties and challenges of getting funding. But the reason we have this session, these talks, is to give you the steps to successfully access the funding. Yes, it'll be challenging, but anything worth wanting, you have to fight for it. So let's not focus a lot on the challenges, but let's look at how we can overcome them and successfully access the funding. There's a lot of opportunities, there's a lot of funding. It's just about knowing how to access it and knowing what to do to reach the investors. So yes, the journey will be long and hard, but ultimately we want it to be as successful as it can. So we always look on the brighter things of life. Thank you.
Thank you. David?
I think entrepreneurs should participate in more of these programs. When you are sick, you look for a doctor. You have a case, you look for a lawyer. If you are looking for capital, keep talking to advisors and to investors. The more you interact with advisors and investors, the more you learn, and the more likely you are to get a recommendation as to where you get funding. So keep associating with the ecosystem where there's capital, there are advisors, there are investors, there are VCs, there are PEs who are looking also to deploy. So keep attending these programs and talk to an advisor.
Okay, thank you very much,
like
gentlemen.
Deloitte too, right?
Yes, like Deloitte. Thank you very much. So to bring the program to a close, we'd like to invite our country managing partner, Mr. Daniel Owusu, to give us the closing remarks.
Right, thank you. And I think I'll finish it up with where David ended. So there are enormous help that are available, but you need to look for it, and you need to find it. And that was a reason for my question. I have a burning desire to ensure that everybody has something to do, and people are working. If you could turn that energy that we are people coming from school and we can find something for each and everyone to do, like we said, people joining together, one or two coming together, and then we'll move on. And then all these big businesses that we're talking about, and that is how they are created. And I think this is a good program for me. I'm highly impressed with a lot of the information. I didn't join from the beginning, but I think I'll look for it and watch again. But that's very, very helpful. So for Deloitte, we are so excited about this, and we look forward to working with the UK Ghana Chamber of Commerce. We're looking for more of this, and if that's the only thing we can do to find opportunity for few of the people, to find opportunity for few businesses to be able to move to the next level, for me, that would be a good achievement. So I want to thank the audience, those who are watching, and also to thank everyone for coming. Just to say that I think I'll try to answer the question about the things that we do. We do far more than that. Okay. So please just come and talk to us. we'll have a solution. And if we don't even have it, either locally, we will look for it internationally for you. But if we don't even have it, we will find a partner that will be able to assist you. Once again, thank you everyone for coming, and we look forward to catching up with you again very soon on another program. Thank you.
Okay, so we'd like to thank each and every one of you for your time today. We hope that the session has been insightful. We would also want to encourage you to follow the UKGCC. So on Facebook, it's at UK Ghana Chamber of Commerce. On Instagram, it's at UK_ Ghana Chamber of Commerce. On X, formerly Twitter, it's UKGCC_ UKGCC _EXEC DIRE. And on YouTube, it's the UK Chamber of Commerce. LinkedIn, it's at UK-Ghana Chamber of Commerce. Thank you all so much for your time. We're going to be taking some pictures in the room. And after that, we invite you to stay for lunch and networking as well. For those online, we hope that all your questions have been answered and the session was insightful. Please follow Deloitte on Instagram, Twitter, and UKGCC. I will keep the conversation going. Thank you.